Hello everyone, welcome to the video. In this video, I'm going to share how I've invested 1 crore rupees with just 4 ETFs. Now, these I believe are the 4 ETFs that are sufficient to hold 1 crore of my net worth. As you can see, my total investment on Kite is 1.37 crores and the current value is 1.8 crores. The reason I'm showing you this is to show you that it's okay to have more than half of your investments in just these ETFs. And that has really worked out well for me. And the reasons extend beyond just getting returns from the stock market. It also means that I don't have to look at my portfolio from time to time. It also means I can sleep well at night. It also means I don't have to read the news because I don't like reading the news. With such a big portfolio, I really don't care about what's happening with the market. And I think that's where the real beauty of this portfolio is. So let's get started. There are 4 ETFs that I'm going to show you. As you can see on the screen, the first ETF, which is my biggest holding, is Nifty Bees. Now, Nifty Bees has around 30 to 31 lakhs, as you can see, of the current value of the portfolio. The next one is Next 50. So for those who are not familiar with these terms, Nifty Bees is an ETF which invests in the first 50 companies of India. So if you were to rank all the companies in India from number 1 onwards based on the size of the company, you don't have to get too much technical about this, but this term is known as market capitalization. You can research more about it. However, just think about the biggest companies in India and rank them by the biggest to the smallest. The first 50 on that list will be your Nifty 50. And that's where this ETF will invest in. So 30 lakh rupees is there. The next 50 on that list is going to be Nifty Next 50. These are the top 100 companies of India. And as you can see, my investment split between Nifty Bees and Next 50 is almost equal. So I have 30 lakh rupees approximately in Nifty Bees and also 30 lakh rupees in Nifty 50. Now, the invested amount could be different, but what I'm managing is the current value. So when I'm going back to rebalance my portfolio once a year or maybe twice a year, I'm only rebalancing based on the current value. And I'm trying to keep these two equal because I feel that over a longer period of time, Next 50 has more opportunity and potential for growth compared to Nifty 50. That being said, both of them are equally split. And this is also the reason, which is a common question I get, why I don't buy Nifty 100. Now, if I buy Nifty 100, imagine I'm putting 1 lakh rupees in Nifty 100. They are not going to be split equally. They're going to be split by the composition of that particular company in the index. So here's how this works. If you look at Nifty Bees, okay, I'm just going to click on this and then click on fundamentals. When you click on fundamentals, you'll be able to see the overall numbers. And when you click on the see details, you'll also be able to scroll down on the ticker tape app and be able to see the entire ETF. So let's open that. So this is the AMC profile. These are the peers. These are the other companies who are investing. Now let's go to the constituents. So it will show you all of the companies that this index invests in. So it's tracking the Nifty 50 index. Let's click on the index and here, okay? So it's going to track this index, which means that if I'm putting, let's say even 100 rupees, then 11% of that 100 rupees, which is 11 rupees, will go in HDFC Bank. 10.47 rupees will go in Reliance. 7.76 rupees will go in ICICI. 5.39 rupees will go in Infosys and 4.48 rupees will go in Larsen and Toubro. The point here that I'm trying to make is that your money will be going into these companies based on the weightage that they have in the index, and the weightage is shown in this column where it shows the percentage. So if I was to buy Nifty 100, then the weightage of the next 50 companies will be much less, and most of my money hence would have been going in the top 50 companies, which is the Nifty 50. However, because I want equal exposure, I'm buying Nifty 50 separately and the next 50 separately. So let me show the next 50 as well so that this is more clear to you. So click on the Nifty Next 50, go on the list. Now if I put 100 rupees here, 5.3 rupees is going into Jio Financial, 4.5 rupees is going into Zomato, 3.61 rupees is going into Trend. However, if I was to buy Nifty 100 directly, now let's open the Nifty 100 index and open the companies that are part of that index. Then if you see my 100 rupees, 9 rupees will go in HDFC. This is fine. The top 50, let's go to Geo Financials. Instead of 5 rupees, now 0.99 rupees will be going into Geo Financials. So my exposure to the next 50 companies will be much less. As you can see, the first 50 ke baad, it's all less than 1 rupee out of 100, out of every 100 rupees that I invest. So I want to have equal exposure to both. And that is why, based on the maths that I just explained, I buy the Nifty 50 separately and next 50 separately. So now let's add up the investment. We've got 30 lakhs here, we've got 30 lakhs here. Approximately we are at 60 lakhs. So 60 lakhs of my portfolio, which is approximately 50%, 40% of my portfolio is in just the Nifty 100, split by Nifty 50 and next 50 because of the strategy that I explained. Now next, let's go to mid 150. Let's go back to our list of all the companies in India. First 50 done, next 50 done. Now the next 150 companies in India is where I put my 22 lakh rupees. Now of course my invested amount was lesser and it's grown by 52.38%, but 22.2, what we are looking at is the current value. Whenever we rebalance the portfolio, we look at the current value. So 22.2 lakh rupees is in mid 150Bs. However, one important thing that you need to note here is that I actually have 2 ETFs for mid cap ETF as well, 2 ETFs for mid cap. So 10 lakh rupees there. So if you add this up, you'll actually find that this is my biggest place of investment. So 22 plus 10 is 32 lakhs, which is even more than the Nifty 50. So my mid cap exposure is higher than my large cap exposure, right? So Nifty 50 and next 50 are my large cap companies. That exposure is lesser. Why? Because I have I'm young, I have better risk appetite, I am I have more time to make money. I run an online business and I keep making more money with the business. I'm growing my business. So basically I can take a little bit more risk. So that mid cap ETF, you can choose either one. You don't have to. Over time, I'm also going to consolidate this into one ETF, which is what, as you can see, I'm doing slowly. Any movement in my portfolio happens very slowly. That's my principle. I don't rush to make quick decisions, which is something that I was doing in the past, but I don't do that anymore. So mid cap 150Bs and mid cap ETF will be the third one. So now we are already at 30, 60, 90, and then around 10. In this case, it's become 20 lakhs over time. I'm going to shrink that position a little bit. 10% of the portfolio is just to balance it with geographical diversification in the US, for which I'm using NASDAQ 100. So if there is a case that the Indian economy is going down, this can balance some of my portfolio. In case there is a big jump in the US economy, then this could give me some upside from the US market. So this I'm trying to keep to 10% of my total portfolio. As you can see now, it's a little bit more than 10%. And this is because of the growth that it has shown. And I'm going to wait a little bit before I actually exit and reinvest this into some other place. But now we have actually seen where the 1 crore rupees is. So the 1 crore rupees is in Nifty 50, Next 50, Mid Cap, and NASDAQ 100. That's all. That's my 1 crore investment. And only recently have I added gold ETF and other things as a hedge against equity. But my first 1 crore has gone into these 4 ETFs. So just to repeat, we have the Nifty Beast, which is the Nifty 50 ETF. We have the Next 50, which is the Nifty Next 50 ETF. Then we have the Mid Cap 150 Beast, which is the Mid Cap ETF. I have an additional Mid Cap ETF, which I'm going to combine. And then finally, number 4 is NASDAQ 100. Those 4 ETFs make up 1 crore of my portfolio. And this is slightly more than 50% of my portfolio based on the current value. But if I was to have only 1 crore rupees, I would be happy having just these 4 ETFs in my portfolio. They have very good expense ratios. They are not actively managed funds. They are passively managed funds. They follow the economies. They follow the Indian large cap, the Indian mid cap, and the US large cap NASDAQ 100 economies. Over a long period of time, US and Indian economies are ever growing. India has way more potential for growth in my personal opinion, and hence majority of my portfolio is in India, and I'm betting on India. And as a long-term investor, if you're basically looking to sleep well at night, you can build your own freedom portfolio. I call this freedom portfolio because it gives me freedom from the stock market. I mean, when I look at what are the companies that are inside Nifty 50 or Next 50. I only do that for the sake of making this video and to show you as an example. I honestly don't even know what companies this money is going in, because I know it's by market cap. So if the logic is correct, the output and the outcome over a long period of time is going to make sense, and you can see this based on past data of the market returns as well. So this is my investing strategy, and this is how I would invest 1 crore rupees. In fact, I should say this is how I have invested 1 crore rupees of my money into the stock market using only these 4 ETFs. Thank you so much for watching. I'll see you in the next one.